Hello, my name is Richard Bonner. I am going to discuss today the Earned Income Tax Credit. One of the most lucrative credits in recent years is called the Earned Income Tax Credit, or EITC for short. This tax credit is for individuals who make roughly less than $50,000. This credit can give you extra money in the form of a refund, or it can be applied to your taxes. So that if you have withheld less than you should have during the year, it can be used for that, and you'll get less of a refund. Each year there are changes to the amounts of earned income and adjusted gross income that you need to be below in order to receive this credit. The government takes into consideration a couple things. The first thing is called your earned income. Your earned income is kind of what it sounds like, all the money you earn. It can be salary, wages, tips, other employee pay, union strike benefits, long-term disability benefits received prior to a minimum retirement age, and net earnings from self-employment. The levels you need to be under are dependent on whether you have any qualifying children who live with you and whether you are married. Note that you are unable to claim this credit should you decide to file married filing separately. Your qualifying children are children that are less than 19 years of age if they are not going to school, or they have to be under 24 if they are a student. They also have to make less than $3,800 if they work. The other requirement is that you have no more, that the husband and wife, or you as a single person, have no more than $3,300 worth of what's known as investment income, and that can be stocks, savings, basically any investments that are in the bank is the best way to put that. Let's go over the chart regarding earned income and adjusted income. Here's the chart. Okay, first I'm going to discuss single people. Single people, you have to make less than $46,227 if you have 3 qualifying children. You have to make less than $43,038 if you have 2 qualifying children. You have to make less than $37,870 if you have 1 qualifying child. And if you have no qualifying children, you have to make less than $14,340. Let's go over married people who are filing jointly. $51,567 is the amount that you have to make less than together with 3 qualifying children. For 2 qualifying children, it would be less than $48,378. 1 qualifying child, it's $43,210. And with no qualifying children, it's $19,680 if you have made less than. Typical credit, here's the maximum credit for the year 2013. With 3 or more qualifying children, you can make up to $6,044. With 2 qualifying children, you can make up to $55,372. With 1 qualifying children, you can make up to $3,250, and with no qualifying children, your credit would be a maximum of $4,487. As you can see, it's pretty lucrative. In order for you to be able to claim this credit, however, there are some rules and questions that the government has put in place. The government calls this due diligence. There are 4 due diligence requirements. I'm not going to go over those, but generally if your tax professional prepares the EITC claims, he or she must interview you and must talk to you and be fairly certain that you qualify for these for these credits. Because if they're not sure and they just do it without asking you, without interviewing you, without talking to you, there are some serious fines that the government can levy against your tax professional. And he doesn't even get the money. They must prepare and keep all worksheets showing how the credit was computed. So if your tax professional is preparing your taxes and they're interviewing you, and they're asking you some pretty strange questions, they're making out the forms for EITC is what they're doing, and they're required to ask you these questions by the government. Or if, like I said before, if they do not ask the questions, you can be fined and your tax professional can be fined. That's about it as far as the Earned Income Tax Credit. If you want to tune in to my next video, we will be discussing some of the changes on these for the year 2013 for the Franchise Tax Board, as